Okay, what's going on at Babcock and Wilcox? Ticker is BW. Um, okay, so they reported results. This thing is a pretty much a hot mess. So this is an engineering and construction company in environmental renewables and thermal. They build and maintain like big steam boilers. And then they're also developing some technologies around hydrogen production and carbon capture. And those two things I can't vet, but that's maybe where they see the upside. So let's see where to start. Where to start? Let's see. Best place to start here is there's really two stories going on. One, BW was a company on the brink of failure when they spun off their nuclear business back in like 2015, 2016 timeframe. And the previous CEO pretty much ran the company into the ground, had a couple of really big project blowups that almost took the company under. B. Riley came in with some rescue financing, and now they own like 30 to 31% of the company, and they've installed management alongside that. So now the company is still trying to recover from that. Now they've grown revenue a decent amount over the years, and adjusted EBITDA is up a bunch too. And 2024, they're projecting adjusted EBITDA in the 100 to 110 million range. The problem is their adjustments are a little sketchy. It's just a little sketchy. And the balance sheet is still not great. These are really lumpy businesses, and the new build side of them can cause big project losses, right? Like if you underwrite a construction project poorly, then you're going to get torpedoed, and it's really going to hurt. Let's see. So the mix of their businesses. Hang on. Here we go. Okay. So the overall business has a pretty good parts and service component to it. The thermal business, which is that maybe less sexy working on coal and nat gas plants business has a really big parts and service and aftermarket component to it, and that business is actually doing fairly well. I think the play for them is probably going to be to sell that or get rid of it somehow and use it to fund what they're trying to do elsewhere in the organization. So, okay, let's look at some numbers. Let's look at some numbers. Um, Let me start here. So I took their EBITDA bridge, which is, sorry, this is going fast. Okay, hang on. Here it is. Okay, adjusted EBITDA reconciliations. This is the list of stuff that's getting added back, and some of it's legit and some of it is not. And I think that's where I take issue in calculating this. So I just said, okay, here's the unadjusted EBITDA number, right? Income, interest, taxes, D&A. And then I tried to code the stuff that I thought was fair, right? Or at least you could make an argument for it. And then the stuff in yellow is just like these are real costs, right? So restructuring costs, well, yes, they're declining. Advisory fees are declining. They're not doing acquisitions. Product development, I'm not sure why that is a legit add back. Financial advisory, that's zeroed out. And then they just have an other line, which is another $2 million a year. Uh, so some of the other ones I think are okay. Contract disposal, that one, you could make an argument one way or another. This is the whole concept of, hey, we wrote some bad business and we have to see it through until it's completed, probably in the next year, and then that should zero out. And then the letter of credit fees. So this is where these types of businesses can really get sideways, and they have to post letters of credit to do the work that they do. And even though it's not technically debt or borrowed money, they have to have the financing there to back it up in case they need to use it, and there are fees associated with that. So that's been growing significantly in the push to do new build work and just with revenue up so much over the last few years. So from the 10K, I just pulled this up from the um, screenshots from the 10K. These are the baby bonds, so we'll come back to that in a second. This is a breakdown of the interest expense each year. So last year you can see 50 million, right? Here's the baby bonds, the senior notes. So that's really been like fully outstanding for the last 2 years to the degree they are now. There's revolver borrowings. These are just deferred financing costs. So you could argue these are like the non-cash piece of interest expense. And then down here you've got stuff for leases, um, letters of credit, and then other stuff. So maybe consider it 50 million minus this 7 million as your true interest expense. And then they recently did a refinancing. Where's that? That's in the 10K. What did they say? Note 25. Maybe. Oh, I'm not in the 10K. Here it is. Okay. So they did a refinancing in January and 150 million asset-based revolver. It's got a borrowing base. A lot of it's going to be for posting letters of credit again, right? So really not different other than it's a bit larger than what they had before. So the 150 million total available is quite a bit more. So okay, maybe we should be keeping some notes here. Like let's keep some notes as to what's going on. Okay, so we got the EBITDA adjustments are a bit sketchy. Okay, this thermal segment likely has value. And here are the segment results. This is the thermal segment. This is just going back to 2019, so the last 5 years. So this is the thermal segment. They report the business with EBITDA by segment, then they've got corporate and R&D to get to their adjusted EBITDA number. Again, the one that we think is kind of sketchy. But the underlying thermal company, which again is pretty exposed to parts and service, so less on the new build side. That's a pretty steady and pretty large chunk of income. And I wonder if this is something they're thinking about selling to fund the company into the future and where they're trying to go. But I don't know. That's what I would do if I were them. Okay. Uh, Interest expense is high, and letter of credit getting higher. So the letters of credit, that's really hurt them. Um, okay, so let's see what else is going on in here. What else is going on in here? Okay, yes, the going concern language. Oops, let's see here. Going concern, that's usually not good when you have to say there's a substantial doubt about our ability to continue as a going concern. That means they think there's a chance they may not make it and they have liquidity problems. And they called that out several times on the call. Um, Working capital, I think, there's some seasonality to the business too, which makes it like, yeah, cool. The full year projection looks positive and is a big EBITDA number and it's a growing EBITDA number, but they can still get hosed along the way. Uh, so here we go. What do I have to say? Continue to operate. Realization of assets, satisfaction of liabilities. Okay, great. Since December 2022, they've done amendments and waivers, and they'll probably keep trying to do that. They've got the new credit facility, and they got the new credit facility, and it was $150 million of credit that was extended to them, and they currently have approximately $5 million available to borrow under that. So that's not good. That means that I mean, I guess it's got a borrowing base, which is like 50% of inventory, 80% of AR, that kind of borrowing base. But still, that's not good if they just put that in place and have already tapped it to the extent that there's only 5 million left. And the cash on the balance sheet. Let's see how we go. Let's go to a balance sheet here. Let's go to a balance sheet here. The cash on the balance sheet isn't fully available for use either, right? Like, so some of that backstops more like letters of credit, and like you need to have minimum levels of cash in place just to like keep things going. So I wouldn't consider that fully available to them for whatever uses they want. So let's come back to our list here. Liquidity risk is real. Going concern. Oops, there we go. Again, I would sell the thermal segment as fast as I could to try and fund that gap. And we'll come back to what that could mean later on. But all right, what else do we have in the 10K? Oh yes, the solar business. And this is a really great example of why engineering and construction companies are kind of crummy businesses. But um, anyway, they bought this solar business, right? So they do like solar construction work, and now it's in discontinued operations. So all the EBITDA numbers you see are net of that. So here are the net losses that they've generated. Well, I guess there was a $2 million net income in 2021. Here we go. 2022, $6.6 million loss. 2023, it was a $118 million loss in their solar business. So while they talked about on the 10K or in the call, let's see, solar. Okay, it's been reclassified. They're trying to sell that business. Yeah, here we go. As we've indicated, we intend to sell that business. We're actively marketing it. I don't know what that's worth, right? Like 118 million of losses. And oh, here I had the 10Q from the previous quarter. That's what I was trying to do earlier is look to see what are the run rate losses for that, right? So solar business, disc ops. What are current run rate losses? So if is that thing bleeding money until they can get rid of it, or have they I mean, they basically said on the call we haven't shuttered it, right? They're trying to maintain it and just clean it up a little bit until they can get rid of it. Okay, so here we go. So the 9 months ended September 30th. It was a $110 million loss. And then at the end of the year, it was 118. So that was an $8 million quarterly loss that they saw in that business as of the December 31st period. So that is a big question mark as to whether, yeah, great. It's good that they're going to try and sell it. I don't know what they'll get for it. The balance sheet doesn't really say there are. So here we go. Current assets held for sale, 18.5 million, but the current liabilities held for sale are 43.6 million. So you'd be lucky if someone came in and took it off your hands for nothing, right? So I don't know what the value of that is, um, but they're gonna have to work hard to try and keep the losses down for that. Okay, so let's look at the debt now. So the debt, one of the positives, I guess, for them in terms of working through the situation they're in is that the debt's flexible. So they just entered into the new, where is it? The new bank loan, revolver, whatever, with Axos Bank, right? So that's the 150 million, and it matures in the earlier of January 18th, 2027, or if they haven't refinanced their senior notes, then it'll be due then. It'll be due, sorry, if they're not refinanced by August 30th, 2025. So they basically have a year and a half to execute this thing. Then the senior notes, right? These are baby bonds, so they're relatively covenant light, and they have due dates into 2026. And then I guess the third piece of it is there's a big block of preferred stock. It's not convertible and it doesn't have a maturity date, but it's, I don't know, 190 million, I want to say, is the balance. So let's come over here. That is flexible, at least in terms of the baby bonds, Cov Light, and 2026 maturity. Axos Lifeline till mid 2025. All right, so they're gonna have to sort this out fast. No, here we go. Okay, so here's what I did to at least try and gauge what's going on here. So I took their EBITDA numbers and I cleaned it up for what I think is actually going on, right? So I tried to strip away mostly the transaction, restructuring, legal, product development, those types of costs, and got to a true number. Oh, this is what they're telling you EBITDA is, right? Excluding the two projects, Climate Bright and Bright Loop. Great names. And those are, I think they said they'd be between 5 and 10 million a year. So, okay, back here. So I started with this, pulled out interest expense as what I think it could be, right? Under the new credit facility, they mentioned 5 million in savings. CapEx is about 10 million a year. I think there's a chance that that could grow if they're trying to grow these two brands. Here's the Climate Bright and Bright Loop. That's the hydrogen production and carbon capture businesses that they're trying to grow. I would love someone to opine on the technical aspect of those. Like, are they legit? Are they good? Like, is it good technology? I mean, that to me, they're really bullish on that. They're really, really bullish on that. Where's this? 9 billion. Here we go. So they say they've got a 9 billion pipeline of identified project opportunities. And they think that that will be, our pipeline includes over 1.5 billion of Climate Bright and Bright Loop opportunities as well. And they think that bookings for those are going to start hitting the $1 billion territory in a couple of years. So that's what I'm curious about, right? Like if that is true and they can survive the balance sheet that they've got, then like this has really interesting potential. I can't qualify whether that's actually real technology though, because I'm not a specialist in that area. All right, so back to my number again, starting with my EBITDA number, pulling out all the fluffy stuff that is sketchy. Okay, so I kept a number just as a baseline for the restructuring transaction costs. I don't know, they should try and get that down to zero, but nobody ever does. The preferred dividends cost them almost 15 million a year, and then the solar business, I just took basically a wild guess. I mean, I don't know how quickly they can wind down costs in that, if they can get rid of it, but this could be upside if they can sell it and make that a zero instead of a negative number. So, and then I just took it divided by the share count, right? So consider this like an owner earnings or net income number. Okay, so that's what I'm getting to. Here's the 2024, right? So I started with their guide and then pulled out all the crummy stuff that they were talking about. And that gets me to a slightly positive number for the year. And I think that's what they said on the call. Lou said something about cash flow being, let's see, said something about being maybe slightly positive. You're like, oh, great. Oh yeah, they're also trying to pull 30 million of costs out of the business. I don't know. Can't really give them any credit for that yet. All right. Anyway, they think that they'll be slightly positive for the year, and that's about where I get, just kind of using some of those numbers that they gave us as a starting point. Now, their adjusted EBITDA has been growing, right? So they've actually been working the bookings and backlog. So if that continued, I don't know. I'm just making an estimate here, and you get that to 125 while really retaining each of those other costs intact. I don't know that this solar business should go out that far. I would imagine you'd shutter that by the end of this year if you can't find a buyer. So you get to a reasonable owner earnings number per share relative to a dollar stock, right? It doesn't solve for your liquidity issue. It doesn't solve for solvency issue. It doesn't solve for leverage. It's just kind of highlighting here's a hypothetical situation or scenario, right? All right. Over here, again, this is probably unrealistic. I just was trying to do it as more of a thought exercise, right? Taking that starting EBITDA number, 110 million, 6.5x. This is, I guess, here's the challenge, right? Is if you take all these pieces of debt divided by that EBITDA number, what do you get? You're gonna get a 5x levered E&C business that's lumpy as hell. I don't know. That's not that great. So okay, the net debt they gave us that. in the investor presentation. And this has good details on all those technologies that they're, yeah, here's the net debt number, 308. Preferred stock, I'm just going to consider it debt because it's really expensive and there's really no future to repaying it anytime soon. Maybe they could convert it, I don't know. New debt, I'm treating it the way they have been treating it, where the letters of credit, the backing for the letters of credit are not actually debt. So this would be just like how much is drawn for revolving purposes, so like working capital build. And you can go read the notes in the 10K to get clarity on that. So you take that minus these, get an equity value, share count, price per share. Yeah, that's higher, but I wouldn't bank on this, right? Because they've got a lot of other things to sort out, and I don't even know if this is the right multiple for a 5x levered E&C business, right? So if you think about this for a second, you've got net debt, preferred stock, and the new revolver debt totaling $551 million. And over here, we've got this thermal business, right, that we said has good margins, it's growing, it's heavy parts and service, so it should be a good cash generator. My guess is they're using the cash from that business to really fund and funnel into these extremely lumpy and crummier other businesses, right? So if you were to sell that while trying to really rein in the cost from those other companies, you may have either a debt-free or very close to company at that point in time. 550 million of total debt on a 66 million EBITDA business. You're probably not going to get 8x for that, but I don't know. That's one way to potentially tackle this problem in 2024, 2025, because they view they view the Climate Bright and Bright Loop as, yeah, so here's the math that they're trying to do, right? Like a BMW project timeline, 2025, producing hydrogen, small unit, first medium unit in 2026, and then they're booking multiple units of this hydrogen production in 2030. So this is an out year bet for them. So if you're trying to bridge the gap to get there, then you might as well sell one of those assets to make that happen. And that's just the Bright Loop hydrogen business. I don't know where the Climate Bright one comes into the picture. So anyway, where's the notes? Where's the notes here? Yeah, so this is where we're at, right? The EBITDA adjustments are sketchy. The thermal business looks pretty good. It'd be interesting to try and get that out of there. The interest expense is really high relative to the debt they've got, thanks to the letters of credit. The liquidity risk is real if they've got $5 million available on that brand new debt package. That's not good. The solar business lost 118 million last year. Run rate looks like, don't know. That's what I'd be curious about. It's in disc ops, but they're still trying to run it until they can sell it. That's not a good thing. The debt seems flexible. I guess they have a little bit of time, assuming they can handle the liquidity situation. So solvency, liquidity, solvency. And then behind that, like there is what are what is the potential for Climate Bright Loop? To me, if you couple that potential with this thermal business, you may have an interesting setup if you could strip away the debt, strip away all the all the stuff that's in there, and just leave it with this thermal business and the potential for these two assets or these two products. That would be an interesting bet, that I would want to look at. And then what happens in a default, right? So you've got baby bonds as the senior notes, and then the other piece is the revolver with Axos. And the revolver is backed by, or guaranteed by, none other than B. Riley, right? Where is it? I don't know, it's in here, but B. Riley is backstopping the note with Axos. So if your debt consists of just the Axos loan, right? Let's go, where are we? Where are we? Projection, here we go. So the debt today, 308, right? That's our baby bonds, this 193, 151. That's 344 of it. Then within that, we've also got, I don't know, like a small loan. I think it's like a project loan, right, at a project level, project financing. And then you've got the new debt, the 150 million with Axos, and that is guaranteed by B. Riley. So what happens in a default situation? Is this something where B. Riley holds the fulcrum security, so to speak, and they can take control of this business in an event of default? I mean, yeah, they own equity, and frankly, they might even own some of the preferred stock. I actually couldn't find if they were one of the original recipients of it, and I couldn't find whether they still own that. Let's find this real quick. Here we go. Preferred stock. Exchange agreement, which we issued B. Riley 2.916 million shares of our preferred stock at $25 a share. I don't know if they still own that. They might still own that. I don't know where that would sit on the B. Riley balance sheet. But anyway, so B. Riley, is B. Riley take ownership? Anyway, that's an interesting thing to figure out, because I guess where I'm going with that is, at the end of the day, if you can clean up some of this other stuff, and the business is growing, and there's actually like light at the end of the tunnel because you have these two lucrative projects, eliminating some of these things, right? Your preferred dividends, the solar business, makes it kind of fascinating. So I don't know what that means, but yeah, these guys have themselves in a real hole. It'll be interesting to see what they're going to do with it. Yeah, it's a real hot mess, but an interesting one. An interesting one.